Hello and welcome to yet another online class where we have a quick look at ratio analysis. And we're going to first start with the liquidity ratios. Liquidity ratios show generally the ability of a company to pay for its short-term obligations. So on the liability side of the balance sheet, in this simple example of a balance sheet, we're looking at accounts payable and notes payable. These are our short-term obligations. And the company might be able to pay for those short-term obligations with some of its assets. However, not all assets here are liquid enough. So we're going to generally look at relatively liquid assets. So if we add up all of the current assets, in this case that's cash and accounts receivable and inventory, and look at it as a ratio of current liabilities, that would give us a current ratio, which is a ratio of current assets to current liabilities. In our particular example, again, that's cash plus accounts receivable plus inventory over accounts payable plus notes payable, which gives us 1.17. Generally, you want this ratio to be above 1 for a healthy company. A bit of a problem with this current ratio is inventory, which includes for a company all of the products that have been produced but haven't been sold yet. If the company isn't doing well in selling its product, then the ability to repay for short-term obligations might be jeopardized. So what if we throw away inventory here and just look at particularly liquid assets, giving us a quick ratio, which is the ratio of current assets minus the inventories over the current liabilities. In our example, that'll be cash plus accounts receivable over the current liabilities, giving us 0.52. In a similar fashion, if the company has trouble collecting the money back on the accounts receivable, we can also have a look at cash ratio, which shows how much cash the company has versus its short-term obligations. So that's of course cash divided by current liabilities, giving us 0.17. Similar to looking at the company's ability to pay for its short-term obligations, we can also have a look at the ability to pay for its longer-term obligations, the long-term debts, in our simple balance sheet. This will be shown by the financial leverage ratios. The first ratio here is total debt ratio, which includes both short-term liabilities as well as any long-term debts. In other words, total assets minus total equity will leave you with all of the debt that the company has. So total liability plus equity minus the equity side divided by total liability plus equity, or total assets. In this case, the company's leverage is around 43%. In a similar way, we can have a look at debt as a ratio of equity rather than total assets, where all liabilities and equity minus equity will give us total debt, divided by equity will give you debt to equity ratio. In this case, debt is only about 75% of total equity. Another ratio in this category is equity multiplier. Think of it as a multiplication effect on the owner's money invested into the company. As you see here, the owner's equity here is only just around 2,000, whereas the company size is approaching 4,000. So with 2,000 invested, the owners are actually managing the company size nearly double. That's the multiplication effect. In our example, that's total assets divided by total equity. Our next ratio in this category involves looking at the income statement rather than the balance sheet. And it shows how much better the company is doing in earnings as opposed to borrowing money. Times interest earned is a ratio of EBIT, earnings before interest and tax, over interest expense. In our example, it's 580 divided by 130. And for a healthy company, this ratio should clearly be greater than 1. One problem with the times interest earned is the actual amount of money that the company is generating might be greater than is shown by the EBIT, because it includes some of the, say, imaginary depreciation costs, the costs that are not really out-of-pocket ones. So to fix for that, we can have a look at the cash coverage ratio, which is EBIT plus depreciation, which will actually eliminate depreciation from the picture, because EBIT already includes depreciation with a negative sign. We add it here, so depreciation cancels out, and we divide the result by the interest expense. So that's EBIT plus depreciation divided by the interest expense. And these are 2 out of 5 categories of ratios. We'll have a look at the other ones later on.